Welcome to Multifamily Loan Talk, the podcast where we teach you how to use other people's money, i.e. the lender's money, to finance your multifamily deals. I'm your host, Roderick Jones, and on today's episode, we are reviewing the Freddie Mac Value Add Loan. Let's get right into it. Alright, so as we can see over here, we have the Freddie Mac Value Add Loan. And if we're looking at the term sheet here, the first question they ask you is, does your multifamily property need light renovation? So this loan is for anybody who is going into a multifamily deal that needs light renovation, that's implementing a light value add strategy. So if we can see right here, what is this loan used for? So we can see right here, our value add loan offers short-term, cost-effective financing for modest property upgrades. So this is only for light value add. It says right here, for extensive rehabilitation projects, look into their moderate rehab loan product. All right, with this loan, borrowers receive competitive pricing and lower execution costs. Both interest-only and uncapped floating rate loans are available. And with all Freddie Mac financing, this loan is of course non-recourse and provides a one-stop shopping for upgrade and permanent financing. So we can see right here, this is a short-term loan, which it states right here, this is a short-term loan, and it's used for upgrades anywhere from $10,000 to $25,000 per unit. So if you're implementing a value add strategy and you need $10,000 to $25,000 per unit to increase the value of the property, this value add loan may be a good product for you. Okay, let's continue to look. So this allows a wide variation in the borrower term and structure needs. This funds, so up to 50% of the funds must be spent on interior units. Budget can be adjusted up to 20% without additional approval. Interest only and uncapped floating rate loan, and they support mixed use properties. So this loan is looking pretty good so far. So if you're doing a value add strategy, this is looking like a pretty decent loan. Okay, so let's look. Who's the eligible borrowers? So developers/operators with experience in multifamily property rehabilitation in the local market with sufficient financial capacity. What does this mean? This means that you have to be a developer or operator, and you have to have significant experience in rehabbing multifamily properties. Now, when they say sufficient financial capacity, what does it mean? Well, they tell you right here in the next line. It says you have to have 1.5 times the standard minimum net worth. You have to have 1.5 times the standard minimum net worth and liquidity requirements for guarantors. So normally they say you have to have a net worth equal to or greater than the loan amount and 9 months of liquidity for financing. Well, you have to have 1.5 times the minimum net worth amount, and you have to have 1.5 times, net worth and liquidity. So it's almost double than what you need. So now let's look at eligible properties. So what can you use this value add loan for? So you can use this value add loan for properties with no more than 500 units in good locations. So here's the stipulation. You have to have 500 units. It can't be no more than 500 units, and it must be in a good location. It must be well-constructed properties requiring modest repairs, market laggards that require capital infusion and new improved management, real estate owned properties in receivership that are capable of improved performance, senior housing, student housing, and mobile home park or manufactured housing communities are not eligible for this loan. So if you're doing senior housing, student housing, or manufactured housing communities, this is not the loan for you. But if you're doing a multifamily property that's in a good location with less than 500 units, this is a good property. This is a good loan for you, especially if you're doing a value add strategy. Now let's go into the terms. So what is the terms of this loan? This loan has 3 years with 12 extension. 3 years of one 12-month extension based on the borrower's request, and one optional 12-month extension based on Freddie Mac's discretion. So this is a 3-year loan with a 12-month 1-year extension. Basically, this is a 3-year loan with 3 plus 1 plus 1. Basically, this is a 3-year loan plus 1 extension, 1-year extension, plus 1-year extension on Freddie Mac. Now let's go with floating rate. So terms, it's going to be floating rate with full term interest only, no cap required. Standard 12-month lockout with option for longer or shorter lockout based on the borrower's preference. Borrower may pay off the loan at any time after the lockout period, but must remit an exit fee of 1%. The exit fee will be waived if the loan is refinanced with Freddie Mac. So what does this mean? This means that you are locked into this value add loan for 1 year. So you cannot pay off this loan earlier than 1 year. And if you pay off this loan after the lockout period is done, you're going to pay a 1% exit fee. Now you can get this exit fee waived if you refinance into a Freddie Mac product. So if you use a value add loan with Freddie Mac, meaning that you're going to buy the property, fix it up, do some repairs, and then you go ahead and refinance out into one of the longer term loans that we talked about, maybe the fixed income or the fixed rate product, and you use that loan for 5 to 10 years, then they're going to waive that 1% exit fee. So you're locked into this value add loan for 1 year. Once your 1 year is up, you can go ahead and refinance. If you choose to refinance, you can refinance into a Freddie Mac product and you won't pay an exit fee. Or if you don't want to finance into a Freddie Mac product, you'll pay a 1% exit fee. All right, so acquisition, it must be used for acquisitions and refinances, not assumable loans. Loan documentation at origination will include a value add rider, which is a budget, which will detail the terms and requirements of the rehabilitation. Escrows will not include real estate taxes, insurance, or replacement reserves. Escrows will include real estate taxes, insurance, and replacement reserves. A 15% cash equity generally is required. And for long-term ownership, cash out is available provided a completion of guarantee on budget improvements in amount at least equal to the cash out of place. Okay, that's good. So what is our upfront fee? Upfront fee, we have to pay a standard 0.5% of the loan amount, which is non-refundable when you accept the terms. So basically, you're going to pay 0.5% of the loan amount, which is not refundable, as an upfront fee, and is subject to be adjusted based on the loan terms. So when you accept your terms for this loan, you're going to be prepared to pay 0.05% of the loan. So let's scroll down and go to our amount. So our amount, how much money is this loan going to give you? So the maximum loan to purchase or loan to value for this value add loan is 85%. Our minimum amortizing debt service coverage ratio is 1.10 times and 1.15 times depending on the market. The property sizing is based on a 7-year size note rate. Appraisal must include as is and as stabilized values. Underwriting must support a 1.30 DCR and a 75% LTV based on as stabilized value supported by the appraisal. So basically what this is saying is your appraisal has to look at the as is value and it has to look at the stabilized value. Once the property is stabilized, the underwriting must support a 1.30 debt service coverage ratio and it must be based on a 75% LTV. All right, standard Freddie Mac underwriting based on as is income and expenses. Refinance test is not required. No pro forma underwriting or future performance. No pro forma underwriting of future performance. All right, so let's look at the rehabilitation. So rehabilitation, it must commence within 90 days of loan origination and must be completed within 33 months. So from the first day you get this loan, you must start. So if you use a value add product, the Freddie Mac value add product, you must start working on the property within 90 days of closing on the loan. And you gotta complete all of your rehabilitation of the property within 33 months. So that's a little bit over 2 years. So the budget that's acceptable when doing this loan is anywhere from $10,000 per unit to $25,000 per unit. The budget can be adjusted up to 20% without additional approval, and 50% of the budget must be used. Now it doesn't say must, it says should be spent on interior units. Okay, completion of guarantee or rehabilitation escrow required, and borrower or servicer reporting required. So they're gonna keep up with the loan and make sure you're doing what you're supposed to do with it. Make sure you're hitting the 90. You started your project within 90 days to make sure that you're on track to complete the renovation within 33 months. To make sure that 50% of the budget is going towards interior. They're going to want to check and make sure that. So that's why they have all these stipulations here. So let's look at loan at maturity and refinance. So at the end of it, the final engineer must review the work of completion and quality, and they must give you a stamp of approval. You can refinance with Freddie Mac with no exit fee. Otherwise, if you choose to go and refinance with another loan product that's not Freddie Mac, you will pay a 1% exit fee. Freddie Mac will re-underwrite the loan according to the current credit policy parameters. 1 year borrower extension option is available for a 0.5% extension fee, assuming no event of default. So if you haven't defaulted a loan or anything like that, you can extend this loan. You can extend this loan for 1 year for a 0.5% fee. All right. Additional Freddie Mac extensions option is available thereafter with a 1% extension fee. So if the project is just taking longer than expected, you can go to Freddie and you can extend it again, but you're going to have to pay a 1% fee for that. If you extend it for 1 year, as we said right here, if you extend it for one year, you're going to have to pay half a percentage point. And if you extend it for additional year after that 1 year extension, then you'll be paying a 1% extension fee. And then fees, standard fees apply, including the application fee and the good faith deposit. And that is it for the value add loan product. So if you're doing a light value add strategy, or if you're implementing a light value add strategy and you plan on using Freddie Mac as your long-term financing, then this value add product may be a good source for you. It may be a good product for you. Because one, you're doing light value add, meaning that if you're in that $10,000 to $25,000 per unit space, and your loan is up to 85%, and it has a 1.10 to 1.15 debt service coverage ratio currently, and by the time the property is going to be stabilized, you can get it up to 1.30 DSCR and a 75% LTV when it's time to refinance. Then this loan may be a good loan for you, especially if you're going to use 50% of it to fix up the interiors of the property. So there's nothing bad to say about this value add loan. It's a pretty straightforward product, and a lot of sponsors don't know about it, but I think this is a good product if you already plan to use Freddie as a long-term financing source anyway. So you can use the value add loan, get the property up to a point that you want to get it up to, and then go ahead and refinance with the Freddie product. So that's it for today's episode. If you need financing for your multifamily properties and you would like to work with a capital advisor, such as myself, don't hesitate to reach out. I have links in the description. Leave a like, a review, and subscribe to the podcast. And with that being said, I'll see you on the next episode.